Mr. David Dropsy here. So I've got Mr. David is joining us from Keller Mortgage. He has been there. I'll let him introduce himself. But today we're going to talk, we're going to cover a wide range of topics. This is unscripted and it'll be raw, and we will end it with a chance for you guys to ask questions that you guys have, because I'm sure that there are plenty of them. And feel free, all gloves are off. Let's be completely transparent, vulnerable. If we don't know something, ask it, because odds are somebody else is going to have the same exact question. So without further ado, Mr. David, can you introduce yourself? Tell us a little about you, and then maybe jump into Keller Mortgage.
Absolutely. Thank you. Thanks for everybody for having me. My name is David Dropsy. I am a senior loan officer here at Keller Mortgage. I have been in the capital markets industry ever since I graduated from the University of Cincinnati all the way back in 2001. And most notably have been in the mortgage industry since early 2015. So I have, and I've joined Keller Mortgage about just a little over 2 to almost 2.5 years ago, back when it was still, it wasn't the initial pilot program that had been set up, but it was still in its infancy stages where not every Keller agent was allowed to utilize it. And so obviously it's grown throughout the mega camps and family reunions that we've had over these past couple of years. They finally did roll it all the way out to every agent being able to access it. And it's evolved a little bit ever since, and it's still evolving to this day, but it's definitely something that we're here to not just help your clients in closing their loans, but we're here to actually be one of your partners. So I don't know, Josh, are you going to scroll through these slides, or is it something that I'm?
No, I will scroll through. So if you need me to jump ahead or whatever, that's cool. Just let me know.
Absolutely. I'll just run through these really quick because I don't want to bore everybody with this stuff, because a lot of you probably know some of it, maybe all of it. So if you just want to go to that what is Zero Plus?
I want to
Sure.
Go back to, so we have, this is coaching with a bunch of brand new agents or agents that have only been licensed for, I think the person on here that's been on the longest, maybe a year.
Mm-hmm.
And so I want to just quickly touch base on what's Keller Mortgage and why do I, as a Keller Williams realtor, care?
Yep. Absolutely. Great question. I mean, for me and my experience that I've sort of felt throughout the last 2.5 years working here at Keller Mortgage and with, probably 150 to 200 different agents across the country is they set us up in mind for you, the agent. So everything that is been established, every policy, every procedure that we do is a way has been put in mind of the agent. Gary Keller was sick of, agents telling him constantly, hey, this lending operation does this poorly. This lending operation, Chase does this, it's terrible. Quicken is the worst on earth, blah, 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 everything. And then even your in-house lenders that you might have had weren't that great either, because there were plenty of pain points throughout the process. So his goal was, all right, well, I'm going to start a mortgage company. And I've heard all of that feedback, and I'm just going to eliminate all of the pain points that I possibly can. And that was the foundational piece of it. So what are some of those pain points? Well, number one, at least in my opinion, is always the appraisal issue with getting it ordered right away. And with the ultimate goal that we have, which is to always close every single one of your purchase contracts on time. So that is goal number one. And how do you do that? Well, you start shaving off pieces of the process that were taking longer and longer, or were the main culprits of delays. And that was sort of the appraisal piece. So when you enter a contract and you're working with a Keller agent, your client, once that's set up in the system and the contract is built in, and we have your closing date, we are ordering your appraisal within 24 hours. And we are getting it done as quickly as possible. We are not charging your client any upfront money, which a lot of operations do. And we do not wait for inspections. We do not wait for any other indicator from you to get the appraisal done. We order it day one so that it's getting done and it's in and it's not causing any delays. The reason why other lenders won't do that is because an appraiser has to be prepaid. So someone has to pay them ahead of time. So if lenders are really poor at closing their loans and getting their deals done, they're going to spend a ton of, if they did what we did, they're going to spend a ton of money on appraisals that don't actually ultimately close. We close over 90% of our loans. The only ones we don't really close are going to be inspection fails, where a client just no longer wants to buy a house due to a bad inspection, or a very low appraisal that you just cannot come to terms with the seller. And obviously you're backing out of the contract. Those are really the only two reasons why we do not close the loan. And of that, so we know that if we're only losing out on 8% of the time, chances are a couple of weeks from now, a month from now, your client's going to be right back in our pipeline with a new contract on a new home, and we will close that one. So at the end, we're going to then get the repeat business that comes with that. So that's sort of the main reason, in my opinion, is that our foundational piece is to never miss your closing, because again, we were built with you guys in mind. And that's just one major aspect of that.
And if I can give my 2 cents worth. So the reason Keller Mortgage is interesting, I say interesting because they're not going to help us out with advertising. They're not going to help us out with marketing. They're not going to print a bunch of flyers for us like other lenders might. You're not going to probably get any, not probably going to get much referrals from them, but you don't get them from any other lenders either, really. But one thing that they do better than anyone I've worked with is they close every single transaction I've gotten into with them. I've never had a reason to doubt that it would close, and the communication is always second to none. And what I mean by that is you'll literally get text prompts once your client has even tried to file for a pre-approval letter. You'll get a text prompt. When they haven't completed their pre-approval process, you'll get a text prompt. So you'll know exactly where your client is at in the process. Once you get in contract and you start clearing hurdles, you'll get text messages. And for me, David knows this, I hate phone calls from vendors. And so, because normally they're just like, hey, just want to let you know we're here, here, and here. I'm like, okay, cool. You could have texted me that. Thank you. They just do that automatically. It's automated. And you always know where you stand. You never feel like you have to go to them asking questions. There have been times where we get, a day or two out and say, hey, have you sent the, closing numbers or whatever? And yep, we've already sent it to the buyer. Just, I'll send one to you too. Odds are they can close early too, in a lot of situations. And so I attended a mastermind, a regional mastermind back when you could attend classes, 2019 or so. And Press McKissick, who runs the region, he was asked this question. He said, somebody asked, why should I use Keller Mortgage when I can get leverage from another lender? And he said, well, and by leverage, I mean like things that I mentioned, prints and marketing, et cetera. And Press said something very succinct. He said, well, you are conflicted. And what he meant by that is that sometimes agents, we've got 8,000 agents across the city. Of the 8,000, I would anticipate that 8,000 want something in return for us referring business to somebody else. It's just human nature. We want something in return for ourselves. If we are not conflicted, we are going to get our buyers the best deal possible on their loan. Because what that does is breeds repeats, right? And Keller Mortgage can offer that because they don't do any of the frills of giving us marketing or giving us stuff. At the end of the day, it's not about us, right? If we're truly being fiduciaries for our customers and our clients, it's placing them first. And so that's why whenever I send out preferred lenders, they're number one on my list. David does a good job of making sure that we all stay abreast of the situation. And if somebody can't get a pre-approval letter, David will call you and say, hey, here's why. And I appreciate that. And coming off of that conversation, I can then go back and say, hey, you didn't get a pre-approval. Here's why. What can we do to fix this, this, and this? So at the end of the day, my challenge to all of us is to not be conflicted when we are choosing lenders. At the same time, all we're asked to do is provide 3 names. With any referral that we give out, we're supposed to provide 3 names so that it doesn't look like we're in bed with any one company, right? And so all you can do is draw the horse to the water. You can't make them drink. So whenever I send my 3 lenders that I prefer, they're always number 1. Keller Mortgage is number 1. And then number 2 and 3 are people that I can get marketing and stuff from. So you never know. If David doesn't respond quick enough, then he loses out on that business. And typically he's fairly quick to respond. So that is why Keller Mortgage, in my opinion, last year of the 42 deals I closed, more than half were with buyers. And I would say I probably closed 15, 16 deals through Keller Mortgage. And every single one, I rest easy versus others where I don't, because I'm trying to track down information. I'm trying to track down where we're at in the process, and it sucks. So that's my spiel for Keller Mortgage. I'm not trying to sell you on it. I'm just trying to pinpoint the why behind it. Additionally, we're the only agents, you guys on this call, you Keller Williams agents are the only ones allowed to use this. It's total leverage for us. And I'm sure David will talk about how we've kept deals together in the past where things looked like they were going to fall through because we have access to this. So let's jump in. David, what is Zero Plus?
Exactly. And this is to your point, Josh, how you were saying, are other lenders out there able to do things that are differently? They are. But you kind of have to pair it together or do an analysis for yourself so what is Zero Plus? And this will lead back into what Josh was just saying. So Zero Plus is simply 3 main things. All of your clients that you recommend to us are going to receive the ability to take advantage of this loan program that we offer on every single deal we do, as long as there's a Keller Williams on the purchase contract. And it can be on the buy side or the listing side. And I'll get to more of that maybe later, but essentially the 0 means 0 lender fees. So we do not charge any lender fees to any of your clients. So there's a host of what lenders put on here. I won't bore you with all the details, but it's basically like an origination, processing, underwriting fee, application. You've seen them. All it is money out of your client's pocket and into that bank or that lending institution. So by us not charging anything, it's already setting you apart and us as a lender versus any other lender out there. The plus is involved with $1,000 closing cost credit that we offer, as long as the loan size is $150,000 or greater, which is not always the case, but let's be honest, that's probably 95% of most houses out there, especially with where prices have gone. So not only are we not charging your clients any money for closing costs, we're paying them $1,000 to essentially do the loan with us. And you might ask, all right, well, how do we do this? Well, we're not paying for your marketing. We're not paying for marketing for ourselves. We're not running big commercials. We don't pay a single dollar for lead generation. It is all based on the good faith that you're recommending clients to us. And all of that money we save on marketing is getting passed back to them. That's why we're able to still do loans by basically paying your clients $1,000 in credit. And so to Josh's point, where other lenders are paying for your marketing and you might generate a deal out of it once a year, think about the client that you close a home with that just saved $3,000 in closing costs. So they now have $3,000 still in their checking account after they bought their brand new home. They love that experience with you. They love the experience with us over at Keller Mortgage. And now they're telling their friends, their family, their coworkers about what you did for them. And that word of mouth is probably worth more than maybe marketing dollars. I mean, obviously I don't have any numbers to back that up, but that's just my humble opinion. And the plus part of this is, so we don't just, the money that we're saving your clients isn't coming with the expense of higher rates, because other lenders could kind of do what we do. But they'd have to jack up the rate in order to get to that level. So we also offer the discounted rate. Some of that you're not going to really see it, but basically if other lenders are at say 3.25, we might be at like 3.125, again, charging no fees and giving that $1,000 credit. And so, and this is just sort of the way to calculate that savings. I've already kind of discussed this a little bit. You can see the list of things that we do not charge for, the $1,000 that we give, and the discounted rate is. So we basically, we go out into the market and we look at average interest rates at par, and we are basically setting our rates at either the same, if not slightly better, in addition to all of these fees that we're not charging and credits that we're giving. So if you want to just keep scrolling through. So what types, I get this all the time. I even get it from Josh. I think you just texted me not too long ago. Hey, do you do VA loans? Yes. Basically, we do anything plain vanilla, right? So primary, secondary investment properties, any purchase or refinance. So if you have a client, this was a big push in the summer. Lots of our agents were just in a way to touch their clients and get them, just get in front of them. They were saying, hey, have you looked at rates? I've got, we've got people over at Keller Mortgage that could do a refinance for you. And it was a way for you guys to get in front of that. Obviously rates have gone up a little bit. So using that tool, maybe not as valuable, but it's still, a good way to maybe touch your clients. But we can do purchase, refinance. We do anything Fannie Mae, Freddie Mac conventional, any FHA deals, VA, USDA, and jumbos, we can go up to 3 million.
Let's I want to pause on this for a second, because you're the first lender that we've heard from speak to us. And we've got some new agents who maybe don't understand the difference between some of these loan types.
Sure. Absolutely.
Would you mind taking a few minutes to describe, just at maybe a 10,000 foot view, like what's the difference between conventional and VA, and why should I care as an agent?
Yep, absolutely. So VAs are pretty easy. Obviously, your buyer would have to be a veteran of the U.S. Armed Forces. They can be active military, or they just have their VA benefits. They then get tapped into a specialized loan product for them straight from the Veterans Affairs, and that it's a better loan for them if they are entitled to use it almost all the time. Every once in a while, it's not a better loan. And that's something that it just takes drilling down and asking a million questions, getting them into the application format. And then as a loan officer, then you're getting those questions answered, and you're trying to figure out which is the best method. But typically that veteran doesn't have to put any money down. They will not have any PMI payment as a result of having no equity in the home on day one.
What's PMI?
PMI is the mortgage insurance that a client will pay if they do not put at least 20% down on their home purchase. As you continue throughout your career, you're going to see most people, I would say way more than 50%, do not have 20% to put down. A lot of people think they can't buy a house without putting 20% down. They absolutely can. There is a PMI payment though, if they're going on a conventional loan, if they do not have that 20%. But a veteran who taps into this VA loan product can put nothing down. They are entitled to put nothing down, and they do not have that additional payment. And that additional payment protects the bank who writes the loan from default up to a certain percentage of the home's value, but they pass the cost of that insurance to protect them onto the buyer. So the buyer has to pay X amount of dollars per month for that insurance policy to protect the bank, because they did not put the 20% down. Conventional loans are Fannie and Freddie. I don't know why it's got different bullet points like that. That is going to be the majority of all clients. I mean, that is a huge percentage of the overall market. What would steer you from a conventional to maybe an FHA loan? Because those are your most two standard loan products. An FHA loan is more geared towards your clients who maybe have less than stellar credit. They have less money to put down, or just a combination of their debt ratios might be a little bit higher as well. So again, you're never, as you, the agent, you may not know exactly what your client is prepared for. That's why it's really important to get them in and be getting them pre-approved with a lender. Which also just kind of takes us back to us as Keller Mortgage. Is we're here to take any one of your clients. You may know them really well. So you may not have a lot of questions about them, but you may not know them at all. And so if you're sending them through into Keller Mortgage, you're helping them get pre-approved so that you can understand which loan type they are going to be most qualified for. An FHA loan specifically, you can put as little as 3.5% down. The PMI and the rate on those can fluctuate based on the actual credit score of the or the PMI will not, but every interest rate that they're going to receive would be dependent on their credit score. But most of the time, an FHA loan client is going to be someone, say, with a 650 credit, not a lot to put down on the house, and they might have a couple of questionable things in their history, like a bankruptcy in the last couple of years, things like that. But the majority of clients are going to do a conventional loan. And I know, I'm sorry if I'm rambling a little bit too much, Josh, back and forth, but
No, this is good information. So with a conventional loan, there's typically not a lot of extra hoops to jump through. And that's why it's in the mind of a seller, the only thing that would beat a cash offer would be a conventional loan, because a conventional loan is pretty cut and dry. There's nothing that I should need to worry about from like appraisal, other than appraisal, really. So talk to us real quickly, David. VA, FHA, USDA, these things come with additional requirements, correct?
Correct. And just speaking on that, Josh, so when you're writing an offer on a home, everyone in the industry has sort of knows what these loan products are, right? So in an environment like now where you're getting 47 offers, I heard you say, on one house. Okay. Everyone knows sort of a pecking order. Obviously the cash deals are going to be number one because they have no hoops to jump through other than maybe an inspection if they want it, right? But most people are still going to need a loan. So you're going to be looking at the pecking order would be a conventional loan, because that person probably has good credit. They've got, 5 to 20% to put down. Their income qualifies them on a conventional loan. So they're going to get put at the top of the pile. A VA loan is good as well, except for VA appraisals are very tough. They have a lot of extra scrutiny that a VA appraiser has to look at the home. And so I have noticed, at least in my personal pipeline, that VA loans seem to get bypassed a little bit more often. And it's sad because these are veterans, right? And so because of that extra appraisal scrutiny, listing agents are putting them maybe in the middle of the pile. At the bottom of the pile right now are FHA clients, because the listing agents know these people are probably worse off for wear in terms of credit, income, and assets. So if I've got 47 offers to look at, I'm putting all the FHA ones at the bottom, and I'm probably never even getting to them, even if those offers are higher, because of the credit worthiness that it's kind of known throughout that. And so FHA loans as well, they have higher scrutiny when it comes to the appraisal, and they typically aren't your strongest financially sound buyers. So that is why it's important for you guys to kind of understand maybe that pecking order. USDA loans are in its own little world. The house itself has to be eligible for a USDA loan. So it's really not going to come up unless you're in a more rural area looking to put in an offer. The listing agent is going to have, typically, if they're smart, they're going to have USDA eligible on it. And if you're not seeing that in any of the notes on the listing, then the house is probably not eligible. So you're never going to care about that. It is the hardest loan to do. I try to avoid it with clients as much as I can. Basically, I call it the Goldilocks loan. You cannot make too much money. You have to make enough. It's the tightest debt ratios of all those loans. So you're hit with the highest scrutiny when it comes to debt ratios, except that you can't make too much money because it's also like supposed to be a low income housing loan. So you really have to hit it like right in the middle. It's like a little sweet spot. And then the appraisal review is tough. All the files go back to the USDA. It's a huge bureaucratic nightmare. It's, and sometimes the USDA even runs out of money. I've had a deal where we were clear to close, ready to go. and the USDA hits us up with, hey, we don't have any funds to fund your loan right now. You're going to have to wait 30 days for us to get an influx of money from the federal government. So with all of those little caveats, I try to avoid them, but every once in a while, we will get one and we'll get it done. So.
Yeah, real quickly before we move on. So conventional is the most sought after from a seller's mindset, and then FHA, VA, et cetera. And the reason is, if there's anything wrong at all with the house, aside from the appraisal being more intense, the appraiser walks through and almost does like a mini inspection as well. So you're getting double inspections on the FHA and the VA stuff. So in order to lend, the appraiser has to verify that certain things have been, like safety concerns, have been met. So if there's a missing stair rail, well, that's a pretty easy fix. But if there's chipping paint, and this home was built before 78 or whatever, you're gonna have to paint the whole house. I've experienced this heartache firsthand when trying to sell like an investment property. If it's not in great shape and you go with an FHA loan, expect to spend a lot more money unless you can negotiate that you're not spending that. But just anticipate a longer timeline typically on those type loans as well. And if it's the only loan type that our person can get, we got to work hard to try and find them something. It might not be that brand new listing that just dropped in the heart of Westerville for a reasonable price. You're probably not going to win that one. But if you go to the MLS and search for homes that have been on the market for a little bit longer, maybe they're hard up. Maybe they would really consider any sort of loan type. So never give up. Where there's a will, there's a way. And these are just the facts.
Absolutely. Absolutely. Yeah. The chip paint thing comes up all the time. I've had plenty of VA and FHA loans and there's nothing you can really pre-negotiate for that. Just so you're aware, the appraiser has to sign off and say the condition of the house is now as is, meaning that he has cleared any sort of concern, which means they've got to go back out and re-inspect it after the seller has done all of those repairs prior to the loan completing. So you can't buy the house. You can't say, hey, I'll pre-fund $1,000 for paint. And you can't close until you've had the painting done. So that's why in this environment where it is complete seller's market, those files are getting put on the bottom if there's multiple offers, even if it's a higher offer.
And not to take business away from you, David, but I don't see FHA 203K on here. You guys don't do that, correct?
We do not. So yeah. So basically, again, we're going to hit every major sort of what I like to call maybe plain vanilla. I know that's maybe a bad phrase, but it is. So construction loans. So where your client might own land and they want to just build, right? I'm not even sure how agents get involved in those in the first place, but I get questions about it all the time. Maybe you're helping them buy the land. I'm not really sure. So we cannot lend on land. We cannot do a construction loan, and we cannot do like a rehab loan like an FHA 203K. Now, the point why we don't do those are the hardest underwriting loans possible. They take the longest amount of time. And honestly, that's a very, very small part of the market out there. And we're here, we're committed to helping you, get your loans done on time on all of these. And if we're missing that small bit of market share, that's just something that we're willing to give up for the amount of resources it would take to do those types of loans.
Yeah, one point that I have, and then one question for you. So the point is, for those of you who have talked to me before or have asked or are interested in what a FHA 203K loan is, it typically will incorporate repairs into the loan. So if your person is an investor buying let's just say a duplex, they're in contract for 450, but also want to rehab it, they can get an additional loan built into that loan. Essentially, that's the 203K piece. Mm-hmm. The question I have is, you mentioned something, and this is great information for all of us to know. Mm-hmm. You are a loan officer. Mm-hmm. You have underwriters as well. Can you describe the role of these people? Because a lot of times clients will say, well, what do the underwriters do? I don't even get what an underwriter is. So can you fill us in just 101, loan officer, underwriter?
Absolutely. We're like the dogs and cats of the lending world. So, because we're usually kind of bickering with one another on all of your files on the back end. You never see it, but a loan originator or loan officer is exactly that. I am here to set up the loan and originate the loan, which means it's my job to know as much as I can about the client, their financial picture, including their credit, their income, their assets, and I build the loan to the specifications of the client. Okay, so that's my job. And then it's my job to analyze that and try to figure out, okay, hey, this person has a lower credit score and they don't have a lot of money. So even though they could probably do a conventional loan, they're better off doing an FHA loan based on their financial criteria. So I'm having conversations with them on which loan is best suited for them, right? That's the role of the loan originator. I'm setting up the loan to the specifications of Fannie Mae, Freddie Mac, FHA standards. An underwriter's job is to approve the loan based on the documentation. So when the client sends in their pay stubs and their W-2s and their bank statements, and I say, all right, they're going to put 5% down on a conventional loan. They're trying to buy a $250,000 house, boom, boom, boom. Everything's been set up in the system. The underwriter is now actually looking at their W-2s, actually dissecting their pay stubs, dissecting their bank statements to show that they have the available funds to buy the home. And once they verified all of those aspects, they then give their blessing in the first form, which is through a pre-approval. In the second form, it's through, so then once you go under contract, it's reviewed again. The underwriter's job now is to continue to analyze those same forms. And then now that you're in contract, you're getting what's called a commitment letter, meaning I, the underwriter, have reviewed this file. I've reviewed the purchase contract. They are conditionally approved for this loan as long as the appraisal comes back good, right? So there's still certain aspects at this point in the process. As long as the appraisal comes back good, as long as they can still confirm that they have employment within 10 days of closing, which is a key aspect. And that's it. After that, as we move along through the process, let's say the appraisal comes back good, clean, and on target with value. We might need an updated pay stub from them, maybe an updated bank statement. The underwriter's going through and reviewing those documents again. And then the final piece is then putting your files into what's called clear to close status. So it's now formally been approved. Everything is signed off. The underwriter is the gatekeeper though. So they have all the working knowledge with all of the rules of Fannie Mae, Freddie Mac, FHA, VA on what are their lending guidelines that we have to adhere to. Because that loan doesn't go to, like, let's say you get a loan with Chase Bank, right? As an example, Chase Bank is not giving you their money. You may write up a check every month to Chase Bank for your mortgage, okay? And you think your loan is with Chase Bank. It is not. That loan has been sold to Fannie Mae, if it's a conventional loan, for example. So Fannie Mae, the federal, basically that's the federal government through the Fannie Mae organization. And they are the ones who, whatever the loan amount is, let's say it's 200,000, they are the ones who actually took $200,000 and shipped it off to the sellers on your behalf. Chase is just collecting your mortgage payment and passing along that money to Fannie Mae. And so basically the underwriters have to adhere to the guidelines of Fannie Mae, Freddie Mac, or FHA, because we have to then take the loan that we're creating for your client and get Fannie Mae or Freddie Mac to buy it. And if the underwriter doesn't do their job, then Fannie Mae will say, no, we're not buying that loan. And so the loan's already been created. So now someone has to then house that loan and service that loan. And so that's why there's such heavy scrutiny on the underwriting process to make sure that all of our loans can get packaged and sent to the appropriate agencies.
Thanks for filling us in, man. I know my first year I was like, well, it's with the underwriter, but I didn't really know what that meant. So good education for us. Thank you. We can continue now.
Yep.
Hey, John.
Yep.
I have a quick question. What kind of communication does Keller Mortgage offer the agents? Are they in constant communication with buyers and agents and updating them on when things are clear to close and when they've, gotten a full appraisals back. Is Keller Mortgage really on top of that communication?
Do you want to answer, Josh, or me? I mean, I can
Yeah,
answer. I feel
Dana,
that we
if you
are.
go back to minutes 1 through 10 of our coaching call, you would know that they send you automatic text messages when you clear hurdles. So they're really on top of the communication. And as I shared at the start, I never have to track them down asking for updates because they always just supply those automatically. So it's
And-
really nice compared to other lenders that I've utilized in the past where I have to hunt them down and beg for updates. I only have to go to David and he's my one-stop shop. David gets me the answer versus some of these other, if you ever work with Chase or Quicken, oh my God, who knows who to go to there. You might have 10 people working on your file and you got to go all the way down the list and it really stinks.
Yeah, and to touch on the client side of that, so clients are getting constant email reminders on certain aspects. So when your appraisal gets ordered and scheduled, like there's an automated email that goes out to the client and it's like, it says, hey, you know, Chelsea Herbert, your appraisal for your purchase is scheduled for, you know, April 20th. Great. And then when the appraisal comes back, once it hits our system, it automatically dumps the appraisal report to the client. Right? And it's in a polished email. And it says, hey, Chelsea Herbert, here's your appraisal on, you know, 101 Elm Street that you're buying. And so there's a lot of automated pieces of that. There are also automated pieces on what the client needs to still provide, right? So when you go into contract, there's still going to be pieces of the puzzle that the underwriter needs to verify and then check off. So like your driver's license, an updated pay stub, things like this. We have the technology that actually automates some of that to the client. It's great because it helps me stay on top of them. You know, and sometimes it's even too much because every once in a while you'll have even a client say, hey, I'm getting these emails and it's like, all right, well, let's take a look. It just prompts a good phone call, then conversation. Okay, hey, I still need your bank statement because the one you sent in was, you know, missing pages or whatever. There's always a reason why it's still hitting them up for documentation. And it just allows us to stay on top of them. Because, you know, at the end of the day, our job is, again, to make sure that loan, if we're closing on May 1st, we're closing on May 1st. We're not coming back to you crying with hat in hand. Hey, Josh, we just couldn't get this one done in time. Can you talk to the listing agent? We're going to need another week. You know, that's something that at Keller, I have never once had to do for any reason that is as the lender's fault. Obviously, there are delays that happen, right? Things that are out of the lender's control, things that are out of your control. So I'm not saying that I've never had a delayed closing, but as far as a responsibility of us as a lender, it's never happened. And that's a piece of why we do what we do.
I really appreciate you revisiting this information. Sorry,
No problem. This slide's really simple. It just reiterates, obviously, the only thing that matters to use us as a lender is that a Keller Williams agent is on the contract. We get every once in a while I'll have where a client was using you for the home sale, but they're going somewhere else. And then now, you know, they're an hour away and they're not going to use you. Then they're going to use some friend in Toledo to buy their house. If they're not on the purchase contract, we can still help them. It's just all the bells and the whistles and the discounts and all of that goes away. And we have to then charge the fees like all the other regular lenders out there. And we're just not as lucrative. I've only done probably one or two of these in my whole time here. It is not what we're geared up to do, even though we can still do it. So we're not going to say no to your client. It's just then, but that gives us the opportunity to say, hey, why don't you recommend a Keller agent in Toledo? And that's where we actually sometimes are driving. It doesn't happen often, but that's when we are occasionally driving a recommendation to an agent or we just prompt you because we know you can get referral fees. Hey, you know, talk to your client. You know, you're doing a great job selling their home here in Columbus. They're buying in Toledo. They don't have an agent up there. You get in with your network and get a referral fee out of it. And boom, there we go. And so all this slide's just saying is that we just need a Keller agent on the contract. And it helps. You can even help a client on one of your listings. I don't do these very often either, because a lot of other agents outside of Keller, maybe they question, oh, you know, what kind of information is Keller Mortgage sharing with the listing agent, right? So you can be the listing agent and still have the buyer take advantage of these deals. So keep that in mind. I do about one of those a month. So it's not as uncommon, but it doesn't happen a lot. Here's, you know, this slide, it just basically tries to quantify it. Okay. Your client won't actually see like a minus 3750, like a minus 3750 anywhere on their documents. That $1,500 in lender fees is probably the average that other lenders are charging. You know, I've seen 1,000, I've seen 3,000, I've seen it all, right? 1,500 is pretty standard. So that's just $1,500 more that your client's spending of their money to pay the lender for their profit. The $1,000 credit, that is the one that they will see a minus. So again, as long as the loan size is 150 or higher, they will actually see a minus $1,000 credit, which is offsetting, you know, a portion of their closing costs. And then the 0.5% discount, they're not going to see that. It's built into our rate sheet. But basically, we have a 0.5 point built into our rate sheet to give them the discounted rate that I had talked about briefly before. And so if you quantified that, you're looking at, you know, say 3750. I like to shy away from talking about like that total dollar amount. When I'm talking to clients, I'm more telling them, hey, our rates are the same, if not less than every other lender out there. So you're going to get a discounted rate. And on top of that, you're probably going to save about $2,500 in fees. So that's $2,500 less that you're bringing to the closing table. And I leave it at that. So here's some of the value to your clients. That first little championship trophy. We did, I mean, obviously in 2020, we had a banner year. This, you know, there was so much business coming through. Purchases were hot, refinances were even hotter. And we had 70% of our loan officers within the Scotsman Guide, which is just a trade magazine that's pretty well known on our side of things. 70% of us made that list, which means you were one of the top loan officers in the country. You're saving thousands of dollars. That's the biggest one. I mean, no one says no to saving at least $2,500. We can offer fast closings. So I think Josh mentioned that before. There was a time when refinances were really dominating the pipeline, and we were advising you, the agents, hey, we can't do less than 30. We are off of that now. We wouldn't go crazy, but if it means winning a deal and you say, hey, we can close in 25 days, we're going to get it done. So you don't have to shy away from that. I wouldn't do anything crazy like 2 weeks, because that's putting everything, the whole process in a huge strain. But if a few days means something to a seller, you know, that is something that you never have to worry with us, and we're going to close on time because that's our commitment. And part of ordering appraisals day one is part of that fast closing time. So yeah, and the rest, they're pretty self-explanatory. I mean, we have technology that we've talked about. Value to you guys, the agents. We do have a higher buyer conversion. I mean, this is just something that I have seen anecdotal feedback from agents in all of our meetings. Simply put, you know, our pre-approval letters are starting to be well known throughout the industry, right? We don't just, me as a loan officer, I'm not entitled to tell you your client is officially pre-approved. If you're in a pinch and you've got to be really fast, and you've got a client who's 800 credit, they've been at their job for 10 years, their debt ratio is 12%, and they've got $1 million in the bank, well, then I can tell you without having to worry about going through the underwriter that your client's probably pretty good. And if you need a pre-qualification letter right then and there, I can generate one for you in 5 minutes. But that's not a lot of clients. So one of the big value adds is we send everyone through underwriting first. And so when you get that pre-approval letter and that's what you're giving with your offer, it is helping agents to convert on, you know, getting their offer accepted. And we are a trusted business partner. You know, Josh said that I was a vendor. I take great offense to that, Josh. That's very offensive. No, I'm just joking. But we feel like an extension of you. When I'm talking to clients, I say it all the time. I am here to make Josh a better agent. I save you thousands of dollars so that you are more inclined to tell other people about Josh, the agent, in helping sell their house or buy their next house. And that is something that I've just ingrained in the way that I talk to clients, is that everything we do is not just with the client in mind, it's with the agent in mind as well, because we truly are a partnership.
Yeah, and to piggyback there, every closing I have, I typically ask the buyer on the buy side, hey, how was your experience with the lender? And what my real hope is that like, oh, they were fine, never had any issues. Because the other answer is, oh my God, it was a nightmare. And I would be the one telling them they were a nightmare to work with. So typically when we use these guys, David and Keller Mortgage, it's nothing but like, well, I really didn't have any huge run-ins with them. So that was good. They communicated well. That's normally the feedback I get.
Yeah, and we don't just do like a cursory review. Like on all of our closings, part of the closing package is a survey for not only your clients, the buyers, but for you as well. And that feedback, it doesn't just go into a black hole. I mean, the executives of the company over here are reviewing that data. And when people handwrite notes on there, I mean, it's getting emailed and put in newsletters. So like when somebody writes something really awesome about you, you know, a screenshot of that survey is getting put into a newsletter. And it's like, hey, look at, you know, Courtney Weber said that, you know, Joe Schmo loan officer did the greatest job ever, got these clients into the house. We had, you know, with little hope to get them into their home, and they're so happy, blah, blah, blah. And that's being passed around. So there are surveys on every closing. And I know that our client surveys are always a little bit lower than our agent surveys, because clients are the ones who feel the pain of, hey, I need another pay stub. Hey, I need another bank statement. And it's like, oh, you know, you get frustrated with the whole process sometimes. But our surveys are truly, like, the scores on there are remarkable. And that's the only reason we exist, because if we didn't get good surveys from you guys, you'd stop sending people our way, and we wouldn't have grown into the lending institution that we have in a basically a 3.5 year period of time. It's been unbelievable.
Yeah, I want to leave the last few minutes here, David, for questions, Q&A. The
Absolutely.
first question coming from Dana is, what is the average minimum credit score for a buyer to benefit to use Keller Mortgage?
Yep. So right now, because of COVID overlays, it's 640 or above, which is a lot tighter than what it is in normal historical times. So I would imagine, you know, I have no idea when these overlays are going to start getting relaxed, but I know that they are starting to get peeled away little by little. So in the past, I could do an FHA loan all the way down to 600. So when we go back to normal, that would probably be what I would expect, is going back to the 600 as a minimum. But for right now, it's, you know, we're looking at 640 on no matter what lending program you do, 640, right at the very moment in time.
Wonderful. Casey asks, what are the average savings? Casey, was your question answered up here with this slide?
Yeah. So that gave me the percentage. I didn't know how that 0.5% came, and now I understand that and stuff. So just gives me a better math.
It's just built into our rate sheet. So your clients won't see a 0.5% discount. It's built into the rates that we offer.
Perfect. Thanks, David.
Mm-hmm.
Jay asks, are you available on weekends or after business hours?
Well, you can't be a loan officer if you're not answering phone calls and texts basically 24 hours, 7 days a week. So for me, I'm a glutton for punishment, and I am always available. But, you know, there are definitely, you know, it runs the gambit over here. But it reflects into your production as a loan officer. But if you're asking me specifically, yes. If you're asking, does every loan officer in the company, maybe not as much, just because then it sort of reflects on their level of you know, desire of production. But at the end of the day, I would say this, when it comes to files in progress, like in contract, everyone is working 7 days a week to make sure that loans get closed on time. So it's definitely a priority. And but yeah, in terms of me, Josh is probably sick of the texts that he gets from me at 8 o'clock at night when he's trying to put his young one down for bedtime, and I'm blowing up his phone.
No, you don't blow it up. You're pretty good, man. Otherwise, I wouldn't have tolerated you enough to ask you to be on a call.
There you go.
What other questions do y'all have, guys? This is your chance to have any question answered.
Yeah, I mean, anything, even just lending institution wise or specific to Keller, I'm here for you.
David, I've got a question. So early on, you were talking about that on day one, you order the appraisal.
Mhm.
And if something falls through and it's not the client's fault, is Keller picking up that cost for the appraisal? You said you get charged regardless if it happens. Is that correct?
Yeah, it doesn't matter whose fault it is. Let's if you go into contract, we're ordering the appraisal because that helps us stay on track for your closing.
Mhm.
The appraiser goes out. Well, they have to be prepaid again. So let's say it costs $500 for that appraisal. We're paying the $500 to get it done up front. The appraiser goes out, does their inspection, they're generating their report. And then let's say your inspections come back and it's, the house is just trashed and now your clients don't want to buy it anymore. And they say, we're out. We never go back to your client and ask them for $500 to pay for the appraisal. We eat that cost 100% of the time. Because again, A, it doesn't happen very often. And B, we know that your client, it's not like your client, that was the only house they're going to buy. And now they're completely out of the market. They're just now no longer going to buy a house. They're going to be back 2 weeks from now with a new contract on a new house. Maybe not in this market, but in a normal market, they're back pretty quickly, right? And they found the right house. And chances are, you're not going to find 2 houses in a row that have horrible inspections that blow up the deal. And so then we close the loan. Now we don't pay for the appraisal. The client will still pay for it. It's just they only pay for it at closing, but they never prepay for it, and they never pay for it even if we paid for it up front and on a deal that did not close.
Okay, thank you.
Yep, absolutely.
And that's not the case with some other lenders, and had some bad ones.
Well, most of them will charge your client a non-refundable $500 deposit, and so by law they can charge them a non-refundable deposit. But all that really is if you just do the math, why are they charging $500? Well, that's usually how much an appraisal costs on average. So lenders that want to get to do the same thing are forcing your clients to pay that $500. So that's another $500 that they have at risk on top of the home inspections. And if they have to back out of that home, they probably just sunk $1,000 on a house that they're not buying. Well, we're saving them 500 of that because they don't have to prepay for the appraisal.
Of all the lenders I've used, I've never had to try to track down an appraiser through Keller Mortgage either. I don't know who y'all use for the appraisals, but there's other companies that must use shoddy one-off appraisers that we can't ever get a hold of. So it can be a challenge that you don't have to negotiate with these guys. Before we close out, I did list David's contact information at the top of the chat. So make sure you write that down, take it down and put it in your records. And if after this call you have any other questions, feel free to shoot it directly to David, or if you're not comfortable with that, shoot it to me. Hopefully this has been good information for y'all. We got time for 1 or 2 more questions.
I don't have a question, but I was just going to say that it's really refreshing to hear the strength in communication and the absence of, I guess, of a lot of delayed closings. Because as Josh had mentioned, I've dealt with a few of the lenders that he did mention that are not so great and have had some really not good experiences. So it's just really refreshing to hear everything you guys do offer.
Yeah, I appreciate that, Chelsea. I mean, again, that's the reason, Mr. Keller set us up in the first place is he was taking all of this feedback that all of his agents kept coming to him and telling him about. And he said, okay, well, they bought a small mortgage company here in Columbus, Ohio, right outside of in Dublin, converted it to Keller Mortgage. I think there were like 8 or 10 loan officers, probably 6 underwriters and a couple of other people. Like, it was really small when it started. And it's been the same deal ever, from the day they started it. Save the client's money. Everything is geared to streamline the speed of closing so that you never miss a closing, so they piloted it with, I don't even know how many agents, but I'm sure it was just a small group, and it just was determined to be successful, and they started expanding. I was part of that first expansion, and they've probably expanded like 3 or 4 more times since, because once they rolled it out to everybody, and the proof is in the numbers. I mean, we went from nothing to within, I think it's 3.5, maybe 4 years at the most, to, I think we're the top 20 in terms of lending institutions out there. So to go from zero, non-existent, to in the top 20, when you're talking about every regional bank, every major bank, every Quicken, guaranteed rate. There's a lot of lenders out there, and they do a ton of business because they advertise a lot. So to go from 0 to that is pretty impressive in my opinion.
All right, guys. Thank you to David. Everyone applaud. Yay, David. Thank you so much. You all have his contact info now. Go to him if you got questions. Please save yourself. If you have the option between Chase and Keller Mortgage, or Quicken and Keller Mortgage, trust me. I got to go. Thank you all. Talk to y'all later.
See you,
Thank you
Josh.
for having me, guys.
Thank you.
Appreciate you.